Okay, let's go over the top reasons traders fail. And man, this never seems to to fail me, right? But this is good. This isn't something negative, this is something positive because it keeps us from doing something that's negative. If we already know and we're inoculated to what's wrong, or we actually can see kind of like the future of what can go wrong on trading, we're going to trade and we're going to do the right thing. So let's go over. Once again, my name is the Beach Trader, and I live a freedom lifestyle. And this is the top reasons traders fail. And it's going to have a lot of information in here, but this is what the 6 categories are. So there's more than just these 6, but these are the categories that I'm fitting everything in. So number 1 is discipline. Number 2 is unrealistic expectations. Number 3 is greed. Number 4 is undercapitalization. Number 5 is poor risk versus reward. And number 6 is incomplete system. And so let's look at number 1 is discipline. And this is a theme is Olympic swimming. So, so you're going to see pictures with Olympic swimmers or something to do with swimming in this whole presentation, but not maintaining trading discipline. That's what we're going to go over right here. And look at this, the trading cycle of discipline. You know, number 1 is risk. Predetermine the level of risk and the amount of money you are willing to lose. And with risk, I've been running computer simulation or simulations. Oh my goodness. And I've been doing like 3-to-1. So, you know, it's almost 3-to-1. It's more like 90% of money. It would be like $90 I want to make and 40 or $40 that I'll be able to lose. And that's how I run most of my stuff, because the computer is telling me that over and over and over again. Like with gold on 5 minutes, it tells me to take a trade and to take profit at $3.50 and to do my stop loss at $1.25. So it's almost a 3-to-1 ratio. And that's the best thing. Also, let's say you go to US 30. On US 30, it tells me to take profit at 2,000 and to stop loss at 750 or 800. So it's almost a 3-to-1, win versus loss, really close. And then so losses, rules when to cut losses and not letting them get out of hand. You have to know how to cut your loss and not let it get out of hand. You got to know how to do that. The stop loss is key. Never set your stop loss at, 3-4 times of what you want to make, right? You're better off with losing more, but gaining bigger. You don't want to lose a whole lot and be like a 90% trader. You don't want to be a 90% trader and winning $10 at a time, but then losing $200 when you lose. That means that you have to win 20 times. And then once you take one loss, you're 50-50. Like you won all this money and then you just lost it all back with one trade, a loss with 20 trades in a row of wins. Don't do that. Entries, rules when to enter trades. Avoid chasing trades or entering prematurely. When the bot tells us to take a trade and everybody's in it and you get a glass of water and you come back, don't jump in the trade unless you're getting it at the price that the bot's telling you, or you're getting at the price that I told you. If it goes back up and, you can get it at the same price, then you can get in. But don't get in just because everybody's winning. Don't feel like that, right? And then don't enter a trade before it's really the right time to get in the trade. Don't say, I'm going to get in before everything starts happening that I know what's going to happen. Unless you know what's going to happen like that, just be careful. Profits. Having rules when to take profits, not being greedy or fearful, right? A lot of people have fear. Lots of people. Like they want to, take their money. Oh man, the trade went wrong. I was down 100 and then the trade starts going back in your favor and you're up $5 and you're like, oh, I'm out. I'm just so happy I broke even, right? Don't think like that. Please don't think like that, right? Greedy. Greedy is you got in the trade, and in your mind, you have a predetermined mind. So you have a predetermined mind that you want to make $300. The trade goes at $300. What I would do is once it goes over $300, I'll set a stop loss at that $300. So if it does go back, and start going the wrong way, then you cash out at $300. That's what I do, right? Then sometimes it keeps on going and you're up $400, $500. Just keep on setting the stop loss, closer and closer to where the money is, and eventually it'll stop loss you out when it starts reversing. But never get into a trade that you want $300 and you just wait. Oh, I hope it goes to 500. And then now it goes back to 100 and you're like, well, I just got 100. No, don't do that. Trading without a plan. I mean, this thing really kills you. Not maintaining trading discipline. The largest mistake any trader can make is to let emotions control trading decisions. Become a successful Forex trader or trader means achieving a few big wins while suffering many smaller losses. Experiencing many consecutive losses is difficult to handle emotionally and can test a trader's patience and confidence. Trying to beat the market or giving into fear and greed can lead to cutting winners short and letting losing trades run out of control. Conquering emotion is achieved by trading within a well-constructed trading plan that assists in maintaining trading discipline. Whether one trades Forex or any other asset class, the first step in achieving success is to create and follow a trading plan. Failing to plan is planning to fail. Is an adage that holds true for any type of trading. The successful trader works within a documented plan that includes risk management rules and specifies the expected return on investment, the ROI. Adhering to a strategic trading plan can help investors evade some of the most common trading pitfalls. If you don't have a plan, you're selling short in what you can accomplish in the market. Learning through trial and error, and this is something like throwing stuff against the wall. They call it throwing the spaghetti against the wall and seeing what sticks. Without a doubt, the most expensive way to learn to trade the currency markets is through trial and error. Discovering the appropriate trading strategy by learning from your mistakes is not an effective way to trade any market. Remember that. Since Forex is considerably different from the equities market, the probabilities of a new trader's sustaining account crippling losses is very high. The most efficient way to become a successful currency trader is to access the experience of successful traders. That's why you guys signed up into the academy, right? This can be done through a formal trading education or through a mentor relationship with somebody who has a notable track record, like the beach trader or the doc. One of the best ways to perfect your skills is to shadow a successful trader. And that's when we trade and I'm coaching you. I'm telling you what I see. I'm telling you when to get in, get out, especially when you add hours of practice on your own. And that's how you're going to become a good trader, not by trial and error, but by learning the right things and doing that over and over and over and over and over again. So how a lack of discipline is killing your performance. Maybe this is you guys. Maybe you guys could take one of these things and say, that is me. So your trading action, how it influencing your performance on the right side, right? Entering trades too early. Trades without an edge. Chasing trades. Reduce expectancy. Taking exit too early. Giving back profits. Taking exits too early. Leaving money on the table. Revenge trading. Trading without an edge. Risking too much. Disproportionate losses. So when you do something on the left side, it ends up hurting you on the right side. And that's what we're talking about right here. And trading without an edge, you guys have to have the edge. You have to. You got to have an edge. You got to know when to hold them, when to fold them, when to go home and, and when to stay. Unrealistic goals. And, I just had 2 Olympic swimmers on here, unrealistic goals. I have great expectations, but not unrealistic goals, right? And it's a woman and a man that are in the Olympics. And, there's different divisions for that for a reason. And that's why I put these pictures here. Like, if you're a woman that's swimming, You want to be the best swimmer in the world, and you could be the fastest swimmer, but for some reason, men can swim a little faster. And that's why they have women and men divisions and different categories for different ways that people swim according to their length and the different things they have. So let's make sure we have the right realistic goals. So they set unrealistic expectations. Let's go over that. Believe me, it will take a lot of time and ego crushing losses before one becomes a consistently profitable trader. There are many things that can be done to speed up the learning curve, but there is no way to completely eliminate it. Some newbie traders make the mistake of thinking that in order to be successful, they should never incur losses. Consequently, they pressure themselves too much and take it hard every time a trade goes against their way. To avoid their fate, you have to accept that you will face losses. So to avoid, taking crazy losses, you got to be accepting of little losses, right? Sometimes you got to blow an account. Sometimes you have to, lose more. Sometimes, if you're trading for pennies and you have an account that should be trading at $100 or $10 at a time, you're really not going anywhere. You're in your head, you're like, I didn't lose my account. Well, not losing your account isn't the goal here. Your goal is to gain an account of real money and start cashing out real money. That's your goal. So never get confused and tell yourself, well, I just don't want to lose money. I don't want to lose my whole account. It's okay if you lose your whole account. I blew a lot of accounts at first. And if you want to become a real trader, you're going to blow a couple accounts. You're just not going to come in the shoot and win every time. Now, that's not saying like the first time you buy your account in audition, you're not going to be successful and cash out money and everything like that. But eventually you will blow an account. It's just, that's what happens. And eventually, guess what? You're going to make a lot of money. So what you want to do is make way more money than lose money. And so if you take that approach, you'll be okay when you take a couple of losses and you're getting close to, burning your account. And then you just say, well, I can get another account pretty soon, or I'll get a lower account for a second and get back to the bigger account. You will experience losing streaks and undergo drawdowns, which will probably make you feel terrible. But you know what? It's okay. Even the best Forex traders out there still experience these things. However, you are entitled to work your butt off, train well, and realize your potential to become a good trader. So here goes the second part. They set unrealistic expectations. Having unrealistic expectations, no matter what anyone says, trading Forex is not a get-rich-quick scheme. So never take this as a get-rich-quick scheme. Becoming proficient enough to accumulate profits is not a sprint. It's a marathon. Success requires recurrent efforts to master the strategies involved, right? Swinging for the fences or trying to force the market to provide abnormal returns usually results in traders risking more capital than warranted by the potential profits. Foregoing trade discipline to gamble on unrealistic gains means abandoning risk and money management rules that are designed to prevent market remorse. So trading is a matter of what? Getting the law of averages to work in your favor. It's not a get-rich-quick scheme. Once again, trading is a matter of getting the law of averages to work in your favor. So what's going to happen is going to happen, but if you can make it happen your way and favor you, then that's what you want. Greed, right? I got a guy that's chasing after the dollar on a hook. He'll probably end up drowning him before he gets to the $100. And if he does get to the $100, it's probably going to mess him up even more, because now guess what? He's hooked on it, and it's not really going to be profitable for him in the long run. That's called sometimes beginner's luck when somebody gets to that 100 real quick. Could be 100,000, could be anything. But greed, chasing greed is just killer. Giving in to greed. Some traders feel that they need to squeeze every last pip out of the move in the market. There is money to be made in the Forex markets every day. Trying to grab every last pip before a currency pair turns can cause you to hold positions too long and set you up to lose a profitable trade that you are pursuing. The solution seems obvious. Don't be greedy. It's fine to shoot for a reasonable profit, but there are plenty of pips to go around. Currencies continue to move every day, so there is no need to get that last pip. The next opportunity is right around the corner. While the forex market is expected to be less volatile in the long term than the equity market, it is obvious that the inability to withstand periodic losses and the negative effect of those periodic losses through high leverage levels are a disaster waiting to happen. These issues are compounded by the fact that the forex market contains a significant level of macroeconomic and political risks that can create short-term pricing inefficiencies and play havoc with the value of certain currency pairs. So this is to say, in layman's term, it's like sometimes you're trading, the different currencies we trade, and then all of a sudden it does something different that it never does. Yeah, that's because of something in the news, something in the economic cycle. So you have to be up on that, what's going to happen each day. You got to read a little bit about the fundamental, foundational stuff that's going to happen in the market. So let's go over managing leverage. Some of you guys don't really know what leverage is. The broker that we use sets your leverage for you. You can go in and change your leverage if you want to. I would keep it at where you're at, but I want to explain leverage because you'll see the word and you need to know what it is. All right. Although these mistakes can afflict all types of traders and investors, issues inherent in the forex market can significantly increase trading risks. A significant amount of financial leverage afforded forex traders presents additional risks that must be managed. So leverage, this is what leverage is, provides traders with an opportunity to enhance returns. But leverage and commercial financial risk is a double-edged sword that amplifies the downside as much as it adds to potential gain. The forex market allows traders to leverage their accounts as much as 400 to 1. So if you're not with ACAP with us, most of us are trading ACAP and you're just trading regular, you could set your account to 400 to 1 leverage, 500 to 1 leverage on some different things. Well, what does that mean? I mean, you could take $1, and for every dollar you're trading, you could really be trading $400. So you could have $1,000 account and you could be trading $400,000 worth of money. Kind of confusing, but this is what forex traders do, which can lead to massive trading gains in some cases and account for crippling losses in others. The market allows traders to use vast amounts of financial risk, but in many cases, it is in the trader's best interest to limit the amount of leverage used. And that's what ACAP has done for us. So we don't have to worry about that. So most professional traders, if you ever get to where you want to put your own leverage, we're going to leverage 2 to 1. Most, people that really know how to trade, master traders, good traders are going to do 2 to 1 leverage. Even though they allow 500 to 1 in different countries, 1,000 to 1 in other countries. I think America has now went down to 100 to 1 or 50 to 1. If you have a broker in America. We have a broker in Australia, so you can leverage more. So leverage by trading one standard lot. So we're talking about $100,000 as one standard lot for every $50,000 in their trading account. So 2 to 1 is that scenario right there. If you have $50,000 in your account, you're basically able to trade up to $100,000 in your account at 2 to 1 leverage. This coincides with one mini lot. A mini lot is $10,000. Right? So $5,000, you could trade up to 10. And a one micro lot is $1,000. Basically, you'll have $500 in there and you'll be trading $1,000 up to $1,000 on a micro lot. And these are different lot sizes that different brokers are going to be using. Now, that's why it's so valuable to have the accounts that we have when we're trading for 100,000 or 25,000. Now you're in a different trading game. Even though you only spent a little bit of money, you're still in the game like a standard lot, right? Standard lot is 100,000. Why do you think the average student is going to have a $100,000 account? Makes sense now. The amount of leverage available comes from the amount of margin that brokers require for each trade. Margin is simply a good faith deposit that you make to insulate the broker from potential losses on a trade. The bank pulls the margin deposits into one very large margin deposit that is uses to make trades with the interbank market. So this is all real trades that are going through real places. Anyone that has ever had a trade go horribly wrong knows about the dreadful margin call, where brokers demand additional cash deposit. If they don't get them, they will sell the position at a loss to mitigate further losses and recoup their capital. So sometimes, if you trade your own money and you go down too much, you might go down. If you have like a account like that, like 400 to 1, and you're trading $400,000, but you only have $1,000 on there. Guess what? If your account goes down $1,000, they're going to hit you with a margin call. They're going to say, well, put in more money right now, or you have no real money. Your money's already wiped out. Right. So you could go up, 10, 20, 30, $100,000 and you're good. But all you can go down is $1,000. See, that's the part of the game you guys have to understand when leverage is counted. So let's look at the margin and the maximum leverage. So if you're at a margin of 5%, maximum leverage is 20 to 1. And you can kind of do the math and see why that is. 3%, 33 to 1, 2%, 50 to 1, 1%, 100 to 1, 0.5% is 200 to 1. 0.25% is when you go all the way up to 400 to 1 on your leverage, okay? Undercapitalization, and this is kind of something that really hurts people, right? I've been trading for years and years and years. For some reason, well, I know why, because I knew my strategy and I kept tight rein on my plan and everything like that, where I could take a little bit of money and make a whole lot of money. Now, everybody's not going to be able to do that. Even big professional traders can't do stuff like that all the time. It's too much pressure when you have so little amount of money and you're shooting for a big, big goal. So that's why we have these accounts to where it's not undercapitalized. You got $100,000 account, you're paying $700. You go up $10,000. Now you have real money. You go up 10,000 again. You could take the money. You take 7,500. The bank takes 2,500. Now you basically started with $700 and you made $7,500 within a month or two. That's not going to happen with just you starting an account at $750. You're not going to be able to make 10 times that in a month or two. And if you could make 10 times that, then can you imagine if you had a 100,000 account and you made 10 times that? That means you would have $1 million in there. That means you would be able to take out like $975,000 and give them their part that they're going to take. Right? Think about it. So undercapitalization, that's what we're talking about. We're talking about starting out with not enough money to really do anything with. Right? Maybe enough money. If you start out with $700 in a regular account, maybe in a month or two, maybe you can make $200 to pay your cell phone bill, right? But if you start out with $700 and you get a $100,000 account, now you're talking. Starting with a little account are not understanding compound gains. Most people, they undercapitalize, they're relying on linear gains. They're not going to compound that account, and they're not going to really understand how to really make it. So let's go over this. Small trading account is a killer, man. Forget about trying to get rich with the $200 or $500 trading account. Forget about it. Just trust me. It has never worked and it will never happen. But if you manage your expectations and get into a long-term mindset, you have a real chance of making it in trading, even if you do not have a lot of starting capital. Now, I have started out an account at $500 and made 100,000 or more in accounts a couple times. I did it. And then I showed everybody how to do it through an academy again. And we started out and we started back from scratch, but it's not going to happen for everybody. Okay. It takes really discipline. When you just have a few $100s in your trading account, your main focus should not be to make money right away. You need to establish a long-term track record and put yourself in a position where you can only start winning money, right? How realistic is it for you to make 1%? Or 1.5% per month? Could you do it? Probably much more comfortable than trying to make 100% every few weeks. Think about that. And then suddenly profitable trading and making money does not sound like a crazy plan anymore. And so people would come in with a $500 account. Some people would lose it. Some people would double it, right? Because they're really risky. They're trading a lot of money and they would go up $1,000. But you could do the same risk with the $100,000 account or with the $25,000 account, and if you choose to risk a lot of it, you can go up $50,000 really quick, or you can go down, the 5% and lose out. So it could still happen for you. If you're somebody that really wants to take risk, you could still do that. You don't have to trade real low volume. You could trade big volume. It comes down to, like I was telling somebody the other day, hey, you need money right now. And $700 isn't really anything for you. You're just trying to get your future in order. Well, take that $100,000 account and trade high volume. It might be to the point where you take one trade and you can go up 10% and now it's real cash in your account, right? Or guess what? If the trade goes the wrong way, you could lose that 5% in one trade. And then you just come back with 700. Eventually, even if you lose $700 in a row, once you hit and you pass the test and then you go up 10%, guess what? You made 7,500. What is that? That's 10 times what you started out with. That's what people thought. I think people don't really understand that. How profitable this really is a trade like that. The reason many Forex traders fail is that they are undercapitalized in relation to the size of the trades they make. It is either greed or the prospect of controlling vast amounts of money with only a small amount of capital that coerces traders to take on such huge and fragile financial risks. For example, at a 100-to-1 leverage, a rather common leverage ratio, it only takes a negative 1% change in price to result in 100% of losses. And every loss, even the small ones, stopped out of a trade earlier, only exacerbates the problem by reducing the overall account balance and further increasing the leverage ratio. Not only does leverage magnify losses, check this out, but it also increases transactional cost as a percent of the account value. People say, well, why aren't you trading Forex all the time? Well, I do trade Forex all the time. But guess what? If you trade one volume of Forex, you're going to have a commission fee of $7. So every time you trade one volume, it's going to cost you $7. So if you trade two volumes, $14, and you can see where that goes. If you trade 0.1 volume, it's going to be, 70 cents. If you trade 0.01 volume, it's going to be 7 cents. So guess what? That starts adding up after a while. So when you do leverage and you're trading, 100-to-1 leverage, and it's saying that you only have a little bit of money in there, but you're trading like 10 to 100 volume at a time. Guess what? If you trade 100 volume, that means just before you even start the trade, you got to pay $700. $700 will make you lose your whole account because you only really have $100 in there, $1,000 in there. So you'll start out a trade and already be wiped out if you're trading Forex. If you're trading gold, with 8 cap, it doesn't charge you a commission. If you trade Bitcoin with 8 cap, it doesn't charge you a commission. And if you charge US 30, it does not charge you a commission. So that really helps you out. The higher the leverage, the higher the transactional cost as a percentage of the account value. And these costs increase as the account value drops. So number 5, risk versus reward ratio. It has people crying and people just jumping out the pool for joy. The difference from gaining massive profits are losing your whole account. And that's what we're talking about right here. And I just want you to look at these pictures and just see what it feels like to win and what it feels like to lose. So poor risk and money management is really probably the first thing. Once you become a good trader, this is the thing that devastates you as a good trader. Now, if you're not a good trader, then discipline is going to be the number one thing that you got to work on. But once you become a good trader, you know what's going on. This poor risk management and money management is going to be the one that hurts you the most. Traders should put as much focus on risk management as they do on developing a strategy. Some naive individuals will trade without protection and abstain from using stop losses and similar tactics in fear of being stopped out too early at any given time. Successful traders know exactly how much of their investment capital is at risk and are satisfied that it is appropriate in relation to the projected benefits. As a trading account becomes larger, capital preservation becomes more important. Diversification among trading strategies and currency pairs in concert with the appropriate trading or position sizing can insulate a trading account from unfixable losses. Superior traders will segment their accounts into separate risk return tranches, where only a small portion of their account is used for high risk trades. Once again, only a small portion. So that would be turning down your volume. Sometimes I'm on the calls, especially if I'm doing like a late night session, late. I'll tell people, hey, I'm going to do a lower risk trade, because that means it is more risky. So this is going to be a lower risk trade, but the reward is going to be bigger if it does go the right way. And the balance is traded conservatively. This type of asset allocation strategy will also ensure that low probability events and broken trades cannot devastate one trading account. So, if I'm tired, I'm already going to put down how much I'm going to trade my volume. It has to be the perfect situation, perfect time for me to trade at a high volume trades. A high win percentage should not be the primary goal of trading. Never in 100 years should you worry about how much you're winning versus how much you're losing. You want to know more about a ratio, how much profit you're winning each time versus how much you're losing each time. And then that should be the percentage that you need. You could be a profitable trader winning 40% of the time if you win 3 times as much every time you lose. Get it? 50% traders. You'll be amazing if you're a 50% trader and you make 3 times more than what you lose every time. It's just an amazing principle that you guys got to understand. The primary goal should be to find trades which give you an edge and percent of asymmetrical risk profile. This means your primary objective should be to achieve a robust risk versus reward ratio, which simply the ratio of how much you have at risk versus how much you gain. Let's say you are right about 50% of the time, a reasonable expectation. Your gains and losses need to be at least 1-to-1. So if you're taking trades and you're winning $50 at a time, or you want to win $30 at a time, guess what? You need to set your stop loss at what? If you're only winning 50% of the time, you need to set your stop loss at the same amount. So if you're doing little trades like making $30 to $50 a time, and then you got your stop loss $200 out, that's not good. That's bad. You want to have your stop loss. If you only want $50, guess what? Your stop loss is at 50. Now you lost 50, so what? You come back in, you win, you broke even. You come back in, you win again, now you're up. But don't go in there and take $50 every time, and then you got your stop loss set at $200. Why? Why is that not good? Because that means that you got to win 4 times in a row before you lose once. So you got to be almost a 90% trader right there, or an 80% trader to even break even. Don't do that to yourself. To tilt the math in your favor, a trader making money on roughly 50% of his or her trades need to aim for a higher unit of reward versus risk. Say like a 1.5-to-1 ratio. You want to win $150 and you got your stop loss to lose $100, right? Or a 2-to-1. A 2-to-1 means you want to win $200 at a time and you want to lose $100 every time you lose. That's great. That means that you could win 1 time and you could take 2 losses and still be even. Too many traders get hung up on trying to achieve a high win percentage. Stop it. Take that out your mind. This is more like baseball. Somebody hits the ball. If you know about baseball, if you're a really good hitter, like one of the top hitters in Major League that gets paid, 20, 30, $50 million a year, all they're doing is hitting 30%. So they get up to bat 10 times, they're only going to hit 3 times. Now, an average batter is only going to hit 2 times every 10 times they get up, right? And then a horrible batter is like 1 time they're going to get a hit out of 10, and they're going to put them in the minor leagues. But nobody's hitting 40% in the whole baseball league. So look at it like baseball. You're going to lose more than win, but you got to win higher amounts than what you're losing, right? It's like basketball. Michael Jordan, they said he was the best, or Steph Curry, they say he's the best. Well, guess what? Steph Curry hits 3-pointers at 40%. So if he takes 10 3-pointers, he's going to make 4 of them. See, the best in the world at what they do are usually at 30 to 40%. And that's what traders are too. Traders, the best of them are at 30 to 40%. Now, I could be a 90% trader. Yes, I have a strategy that's 90%. Guess what? But we're not going to be going the long term. We're not going to be taking long trades all the time. We're going to be getting in, monitoring our trades, getting out, right? If I just set my stuff to make 3 times the amount to 1 loss, right? then I'm not even worried about being a 90% trader. That's not even what I'm worried about. I'm worried about making money. I might be a 50% trader or 40% trader and take $5,000 and make $240,000. That's what you guys have to understand. It's not about being, I won every trade. This is not what we're in. It's not sprinters. Like sprinters need to win every time. You know, people that swim in the Olympic in the pool, they need to win every time to win the Olympic gold medal. That's not what we're doing, right? Losing is just part of the process. A fact that as a trader, you must get comfortable with taking losses. You guys are going to have to do that. It's just what it is. Incomplete system. This is number 6, you guys. Number 6, incomplete system. You see, you know, somebody's training somebody right here. And that's what people are usually missing. So what is a trading system? Man, a trading system is boom, boom, bow, right? A trading system is a set of rules that can be based on technical indicators or fundamental analysis. Now, technical indicators are like the bounce strategy. We have our technical indicators that we use, the Bollinger Band, the MFI, the MACD, you know, the Stochastic RSI. And so that's the technical indicators that we use on the bounce strategy. The fundamental analysis is when we're looking at the news. I read the news. I want to know what's going on in the day. I want to know what's supposed to happen in 2 days, in 3 days. I want to know what happened 2 days ago, right? A trading system tells a trader when and how to trade. In many cases, trading systems act like a blueprint for trading. And that's what I give you guys. You guys have to know what I'm really giving you. A trading system is important for a trader because without it, there is no way a trader can expect to trade. Despite getting lucky a few times, one cannot expect to remain consistently profitable without following a trading system or a strategy. Let's just remember that, right? Failing to adapt to the market happens when you don't have that. Before the market even opens, you should create a what? A plan for every trade. Conducting scenario analysis and planning the moves and counter moves for every potential market situation can significantly reduce the risk of large unexpected losses. As the market changes, it presents new opportunities and risks. No panacea or foolproof system can persistently prevail over the long term. The most successful traders adapt to market changes and modify their strategies to conform to them. Successful traders plan for low probability events and are rarely surprised if they occur. Through an education adaptation process, they stay ahead of the pack and continually find new and creative ways to profit from the evolving market. So one of the things I do is I don't trade big on Monday, Friday, Saturday, or Sunday. I don't really even trade that much. I only really trade Tuesday, Wednesday, and Thursday, and half of the day Friday. And that's what I do. I could trade at night on those days too. There's no time limit, but that's one of the things that I have adapted over the years. I used to trade on Monday a lot, and I found out that guess what? If I'm a 90% trader or if I'm making profit all the time on Monday, it would go down. Even 10%. I'll turn to an 80% trader and, you know, be making less money, a little bit of money instead. So I just said, forget Monday. I'll just, you know, read and do more on Monday because Monday, what? Is different. It's a different market on Monday, or it's a different market after a holiday. I know that, so I don't trade big right after holiday, right? Many of the factors that cause Forex traders to fail are similar to those that plague investors in other asset classes. The simplest way to avoid some of these pitfalls is to build a relationship with other successful Forex traders who can teach you the trading disciplines required by an asset class. And I'm telling you guys need to watch my videos in the back office, and you guys need to know what is going on. Because if you don't understand risk versus reward, and you don't understand the system that I'm doing every time that I go over, if you guys aren't running that same system or running a system that has proven to be successful, you guys aren't going to win a lot, including the risk and money management rules required to trade the Forex market. Only then will you be able to plan appropriately and trade with the return expectations that keep you from taking an excessive risk for the potential benefits. While understanding the macroeconomic, technical, and fundamental analysis necessary for trading Forex, it is as important as the requisite trading psychology. Your trading psychology, I always go over that. There's a video in the back office on that too. One of the largest factors that separates success from failure is a trader's ability to manage a trading account, right? There's different things, psychology, like 95% of trading is from your brain, And so you got to be very, very careful on how you think and how you go into trading in your mindset. The keys to account management include making sure to be sufficiently capitalized, using appropriate trading sizing, and limiting financial risk by using smart leverage levels. Incomplete system. Not having a trading system or having an incomplete trading system are both cardinal sins in trading and guarantee that you will never make money as a trader. You need to be crystal clear about everything that you are doing in your trading. You got to know what you're doing, right? A trading system is also more than just a way to define entries. A trading system defines the following areas of your trading, like this. When do you get into a trade? You need to know that, right? Exact rules, tools you use, market structure, and the timing, etc. You got to know when you're getting into a trade. How do you set your stops? See, some people don't know when to set their stops, what number to set it at. It's always a percentage every time. Point-based versus chart-based approach. Do you use protection? How much buffer do you give your stop loss? How do you get set targets? How do you set targets, right? That means fixed, risk versus reward, flexible targets, right? Sometimes when you're trading really fast with the doc, you might put your stop loss out, but don't put it out too far. You know, if it's consolidated, you put it outside of the consolidation. If it keeps on going up and down, you're going to make money. You got to know that. How do you manage trades? You know, how do you deal with news? Do you even read the news? Do you know what the news is saying? You know, you should. How do you deal with correlated trades? What does that mean? Some people are trading, you know, something to go up and they're trading the same currency to go down. It's like the other side of the currency, like gold and Australian versus the USD. You could be in two trades. You could be in gold to go up and you know, odd versus the USD to go down, and you're doing the exact opposite. That's correlated trades. The odd goes up when gold goes up. The USD goes down, USD goes down when USD goes down. So if you don't know that the 80% of the time that's going to happen, you could be in both those trades, like counteracting on yourself. What do you do with weekend positions? You know, we don't trade on the weekends. So you guys could trade on a demo account on the weekends or do whatever, but don't trade real money on the weekends. It's too unstable. When do you cut the trades? You know, if a trade lasts for so long, me and my programmer, we're talking about, you know, if a trade lasts 6 candles, then we just liquidate it wherever it's at. As long as once it goes into a little bit of profit, we're out. It didn't do what we thought it was going to do for 6 candles. Enough is enough. How long are you going to wait there for it to do it? Get out, get back in later. But don't just sit on a trade for forever and ever and ever. Sometimes you got to take a little loss before it becomes a big loss. The list goes on, but you need to have these precise answers for each part of your trading. If you don't, you will lack confidence, and your trading will be very emotional and stressful. And everybody has been there where you're looking at a trade and it starts getting stressful. This is a no stress express experience when you're trading. You know, a lot of people, they trade and they make it so stressful. No, this is supposed to be fun. This shouldn't be like sit there and watch your trade the whole time. You know, sit there and put your stop loss and your take profit, set it up. If you're trading by yourself, if you're not trading with a professional trader, you know, set it up and walk away. Come back and you either won or lost. But you're not stressing out and boggling your brain because it keeps on going up and down. Think about that. No plan to exit losing trades. This is the worst thing. And this is like the last part, basically. And I'm going to do a little bonus part. Many traders placing trades in the market with only an end point in mind, target profit. This is saying, I know the markets will definitely go in my direction, and I have no need to worry about a loss. You put on a long trade and watch price moving in your favor. Almost immediately, hurrah, it feels good. Makes you feel like you're in control of everything. Another 35 pips more to profit target. Then you notice your trade starts going against you, and you have given back all your profits. You're now in the red. You believe it's a matter of time before it turns in your favor once more. So you hold on to that belief, but the ticker continues to move further against you. Heck, you're no longer thinking about your target profits. Now you simply want to get out at a break even and call it quits, go to bed, right? Price slowly creeps back in your favor, but not enough to put you in the black. You hold on to the same belief still, as price now shows it is about to reverse. That's when you should probably get out right here. When you think it's going to reverse and you're back to where you started almost, even taking a little loss, you get out because you see that this trade has now pivoted and is going the wrong way. Guess what? The reversal didn't come and price broke new lows. Your trading account starts to race along with it. Your margin gets depleted day after day. Sounds familiar? Well, that's what most people are going through. Now let's look at it this way. When you are driving a car, you require having a pair of brakes in it, right? Because you know there are opposing traffic against you, requiring you to slow or even stop. If not, you will be in an accident. See? That's why we have brakes on a car. That's like a stop loss on an account. Likewise, when trading, you require stop loss because you know the markets can go against you, no matter how good your analysis is. Putting it on each trade without a plan for exit is like driving a car with no brakes on it. It's a matter of time before you crash. It's just a matter of time. Trading is a game of probabilities. This means you always have the possibility of a loss on each trade. So always have a stop loss in place every time, please, you guys. So the next time somebody asks you, why do day traders fail? You know why, because I went over all the reasons, right? And we're going to go over the bonus. This is the bonus reason right here. This is like outside of it. And this is something that I love to talk out of academy, right? Thinking it's easy, right? You guys have a professional that's training you how to swim and it's holding you up, right? But as soon as this professional walks away and you think you're floating, like you're like, you know, my son was like, mommy, daddy, look, I'm swimming. And the person's holding them up just by like a little finger. They're holding them up and they're surviving and they're winning, right? And then that person walks away and all of a sudden the kid starts drowning or starts like, oh my goodness, they're underwater for a second. They got to jump off the bottom of the pool to get back up. And it's like, that's the kind of thinking that will crush you as a trader. This is the bonus one right here. Is really quick, but thinking is easy. Trading like what? It's a hobby. So if you're trading to make life-changing income and you take it as a hobby and all you want to do is come on and just, you know, listen to me and the doc and take trades with us, that's more of like a hobby. You're not like training by yourself ever. You're not reading the news. You're not doing that. Then you're probably not going to be making life-changing income anytime soon. Let's just be honest with ourselves, okay? If you learn from us and then you take time to start looking at other things and learning more, then you're probably thinking of this as what? Like it's your business or it's a career. And if you're not thinking, if you're just thinking it's like a hobby, that's fine. You probably won't make $1 million trading, okay? You probably make about $100,000. But guess what? If you make $100,000 a year, that's more than what most people are making. And this is a side thing. This is something that you're doing maybe 2-3 hours a day. So it's still life-changing income to everybody on this call just to trade with us and make $100,000 a year. But if you want that $1 million a year, you're going to have to go for it. You're going to have to learn and really strive, right? So let's just go over this. Thinking it's easy. This is what happens. If you want to be a doctor or eventually make a 6-figure income every year, you have to pass what? A slew of gatekeepers. What does that mean? Beginning with your first 4 years of the university. So what? It takes you 4 years to become a doctor? No, that's just your 4 years that you got to do at the first university. Then you got to what? Then you got to go to medical school gatekeepers. Ensure that only those that are academically suited to enter the school. So even if you did good at the university, you still can't be a doctor because now you got to have good enough grades from that experience to go to medical school. During your years in the medical school, there are numerous tests that judge your emotional abilities. Are you emotionally acceptable to work as a doctor, to handle the job along with your intelligence? Once you finish that school, great, I'm done. I could be a doctor. No, not yet. You're about 8 years in right now. Now you have to pass another gatekeeper, the licensing board of each state. Well, what do you have to do to get a license as a doctor after 8 years? Well, guess what? That usually takes 2 to 4 years to get that license and say that you could practice. And you got to what? You got to intern. You got to be under professionals that show you what to do every day. Once you have your license, you now have to join what? You got to join a hospital or you got to join what? A law firm. which means you have to get by their gatekeepers. So if you work at a hospital, now you got to go under the hospital and you got to do something for 6 months to a year with good standing before you're really a doctor there. Before that, you're like a certified nurse in their mind. Once you're in, you now have to bust your butt for years to make partner if you're in a law firm, or get to the point where you can open your own private practice as a doctor, and you go in and you're basically your own boss instead of working for Kaiser or the big guys, right? Now, let's look at trading, because we're talking about somebody that can make $100,000 or $200,000 a year here. These two different things, right? Now let's look at trading. What do you need to become a trader? Well, if I asked everybody a question, they probably wouldn't know. All you need is a computer and $500. Yet everyone thinks they'll be making a consistent six-figure income in a few months or even years. Forget the fact that the industry is full of some very, very intelligent people who have spent years learning how to be a consistent trader. 17 years of my life, I've been trading. Not 8 hours a day, but I've been trading. An hour, 2 hours, 3 hours a day, right? Forget the fact that you're going up against organizations that have millions and billions of dollars to throw behind their traders in the form of support. That's what we have. See, Surge Trader reached out to me and said, hey, you got an academy. You were in 2 other academies. People were very successful. We want your students and you to come to our bank, use our money so we can make 25% off of your students and they make 75%, which sounds like a win-win for everybody around the board. And so I said, yes, that makes sense, because I don't want to trade people that are undercapitalized all the time. I wanted to trade with people that have the right capitalization so where they can make $100,000 a year. Forget the fact that these same organizations are playing on a different field than you are. Well, why are they? Because you got a few indicators. They got great indicators. That's what you have right here. You have a great indicator, a proven success rate. The bounce strategy is proven. I talk to people that have been trading 30, 40 years. I show them what I'm doing and they try to switch what they're doing. People that were making bots before, they said, man, if you put your strategy in a bot, bro, you'll make everybody money. And that's why I prayed to the Lord. I need to make a bot for everybody. I need to have a strategy for everybody to where they can look and I don't even have to be there. And God brings somebody in my life to fulfill that for everybody, not just for me, because I wanted to do it for everybody. That's why God did that for me. A broker that doesn't screw you too much, right? Guess what? We have a broker, right, called 8cap, but they're in league with the bank, a bank. So they're both, American SEC regulates the bank that we're at, so nothing can be against the law. Then you got 8cap, and that's the highest regulated place is Australia. That's where our brokers ran out of. So these both things are highly regulated, so we know they're going to give us our money. We know we're doing right. And then the bank is on your side. The bank wants you to win so they can get 25%, so you can get 75%. Man, this is a win-win scenario right here. We figured it out. And in a year or two, you'll be living the high life, right? Is it any wonder so many fail? Just be honest, you guys. Let's be honest here. I'm sure you even thought that you could chill on the beach of Hawaii. Yeah, the beach trader. Enter a few orders into the market and poof, 5 figures started pouring in every month, right? The beach trader, right? I want to be the beach trader. That's great. And you can be. But you had to get through all those other things that will make you fail to become what you really want to be. Can it be done? Oh, yes. But it takes sufficient capital, which we have. Boom. And years of hard work to get there. If you want to make $100,000 a year trading, it's going to take some years. You'll probably make it your first year. You might make 50,000 your second year. You might keep on making 100,000. But are you willing to stay the long course and make $1 million? That's what the thing is. Hopefully you guys really listen to this and you guys really learned something here. And I really want you guys to watch this over and over and over again to really help you become the trader you want to be and live the life and the dreams that you really want. Thank you so much. This is the Beach Trader.